Your savings account pays 0.5% interest. Inflation runs at 6%. Every year you work, you're losing 5.5% of your purchasing power. That's not economic policy. That's confiscation by design. The dollar in your wallet is worth 97% less than it was in 1913. Most people think that's just inflation, natural economic erosion over time. But what if I told you the biggest devaluation is still coming, and it won't take 100 years? It could happen in a single weekend. Central banks across the world are talking about something most people have never heard of. A coordinated currency reset. Not a collapse, not hyperinflation. Something more controlled, more surgical. A one-time repricing of major currencies designed to erase debt, rebalance trade, and shift economic power without asking permission from anyone holding dollars. This isn't conspiracy theory. It's monetary history repeating itself. 1933. President Roosevelt signs Executive Order 6102. Overnight, private gold ownership becomes illegal. The government confiscates gold at $20.67 per ounce, then immediately revalues it to $35. A 69% devaluation, debts shrink. The government gets richer, savers get destroyed. The mechanics were elegant in their brutality. American citizens had until May 1st to turn in their gold. Anyone caught hoarding faced 10 years in prison and a $10,000 fine. That's equivalent to nearly $200,000 today. Banks were ordered to break open safe deposit boxes. Gold certificates became worthless paper overnight. And once the government had collected the gold, once private citizens couldn't protect themselves, that's when the revaluation happened. The justification was economic emergency. The Great Depression, bank failures, deflation spiraling out of control. Roosevelt needed to expand the money supply, and gold was standing in the way. By confiscating and revaluing it, he effectively devalued every dollar in circulation by 41%. Your savings lost nearly half their purchasing power, not over decades, but in months. And here's what most history books don't tell you. The wealthy saw it coming. J.P. Morgan, the Rockefellers, the Mellons, they moved assets into foreign accounts, into real estate, into businesses that would benefit from devaluation. The working class, the middle class, the people who kept their savings in banks because that's what responsible citizens did, they got wiped out. That's the first pattern. Currency resets don't happen by accident. They happen by design. And they're always framed as necessary sacrifice for the greater good. 1971, Richard Nixon faces a different crisis. The Vietnam War is draining the treasury. Social programs are expanding. European central banks are demanding to convert their dollars into gold because they see the writing on the wall. The United States is printing more money than it has gold to back it. On August 15th, Nixon appears on television. Camp David meetings have just concluded. The gold window is closing. No more converting dollars to gold at $35 per ounce. It's temporary, he says. A necessary measure to protect American workers from international speculators. But temporary becomes permanent. The Bretton Woods system, which had governed international monetary relations since 1944, collapses within 2 years. The dollar loses 30% of its value against major currencies. Countries holding U.S. Treasury bonds watch their reserves evaporate. Oil-producing nations, who had been selling petroleum in dollars under the assumption those dollars were backed by gold, realize they've been trading real resources for paper promises. This is when the petrodollar system gets engineered. Henry Kissinger flies to Saudi Arabia. A deal is struck. Oil will only be sold in dollars. Saudi Arabia will invest its dollar surplus in U.S. Treasury bonds. In exchange, America provides military protection and weapons. It's brilliant, it's coercive, and it creates artificial demand for dollars that props up the currency for another 50 years. But here's the thing about artificial demand. It only works as long as the arrangement holds. And right now, that arrangement is fracturing. 1985. The Plaza Accord. The United States is running massive trade deficits. Japan is flooding American markets with cars and electronics. Germany is exporting industrial goods at prices U.S. manufacturers can't compete with. The dollar is too strong. American factories are closing. Unemployment is rising in the Rust Belt. So finance ministers from 5 countries meet at the Plaza Hotel in New York. The United States, Japan, West Germany, France, and the United Kingdom. They agree to a coordinated intervention. Central banks will sell dollars and buy yen in Deutschmarks. The goal is to devalue the dollar by 40 to 50%. And it works. Within 2 years, the dollar drops exactly as planned. American exports become competitive again. But Japan's economy enters a deflationary spiral that lasts 3 decades. The Nikkei stock index crashes and doesn't recover for 25 years. An entire generation of Japanese workers sees their wealth destroyed. That's the second pattern. Currency resets are zero-sum games. When one country devalues, another country pays the price. The question is always who holds the bag when the music stops. Now look at where we are today. The United States national debt exceeds $35 trillion. That number is so large it's almost meaningless. Let me put it in perspective. If you spent $1 million every single day, it would take you 95,000 years to spend $35 trillion. The entire federal government revenue for 2023 was $4.4 trillion. That means even if the government took every dollar it collected in taxes and paid nothing for defense, nothing for Social Security, nothing for Medicare, nothing for anything, it would take 8 years just to pay off the existing debt. But the debt isn't shrinking, it's accelerating. The government borrows approximately $2 trillion every year just to keep operating. Interest payments on that debt now exceed $1.1 trillion annually. That's more than the defense budget, more than Medicare. Interest is now the second largest line item in the federal budget after Social Security. And here's where the math becomes impossible. As debt grows, interest payments grow. As interest payments grow, the government has to borrow more to cover them. As borrowing increases, interest rates rise because creditors demand higher returns for higher risk. As interest rates rise, debt service costs explode even faster. It's a feedback loop. Analysts call it a sovereign debt spiral. Once it starts, there are only 3 ways out. Option 1 is default. The government simply announces it won't pay back what it owes. Bondholders lose everything. Treasury markets collapse. The dollar becomes worthless overnight. International trade stops because nobody will accept dollars as payment. This is what happened to Argentina, to Greece, to Lebanon. It's economic and political suicide for any country that controls a reserve currency. Option 2 is hyperinflation. The government prints money to pay its debts. Prices spiral out of control. Savings evaporate. Patents become worthless. This is what happened to Weimar, Germany, to Zimbabwe, to Venezuela. It destroys the social fabric. It causes political upheaval. It's a slower form of default, but just as devastating. Option 3 is a reset. The government doesn't default. It doesn't hyperinflate. Instead, it coordinates with other nations to revalue the currency. Debts get repriced. The burden gets spread internationally. Wealth gets quietly transferred from savers to debtors, from creditors to borrowers, from the middle class to the government. Which option do you think central bankers prefer? Here's what most people don't understand. Modern monetary systems are built on confidence, not value. The dollar isn't backed by gold. It's not backed by silver. It's backed by the promise that the U.S. government will accept it for tax payments and that other countries will accept it for trade. That's it. It's a collective agreement, and agreements can be changed. Behind closed doors, the infrastructure for that change is already being built. The Bank for International Settlements, which is essentially the central bank for central banks, has been running pilot programs for something called Project Enbridge. It's a multi-central bank digital currency platform that allows countries to trade with each other without using dollars as an intermediary. China is involved. Russia is involved. Saudi Arabia and the United Arab Emirates are involved. Thailand, Hong Kong. These aren't small players. China is the world's second largest economy. Russia controls massive energy reserves. Saudi Arabia is the swing producer in global oil markets. The UAE is a major financial hub. And they're all building payment systems that bypass the dollar. Not because they hate America, not because of ideology, because they've done the math. They see the debt, they see the deficits, they see the spending, and they know what comes next. If current trends continue, many economists argue the dollar's share of global foreign exchange reserves could fall below 50% within 5 years. Right now, it sits at about 59%. That's down from 71% in 1999. The decline is slow, steady, but accelerating. When that threshold breaks, when the dollar loses its majority status, the game changes. Countries no longer have an overwhelming incentive to hold dollars. Central banks Start diversifying faster. Demand drops. Value drops. And suddenly the United States faces a choice. Accept decline gradually, which means lower standards of living, political instability, and loss of global influence. Or reset the system quickly, take the pain all at once, and reboot with a new monetary arrangement. History suggests they choose the reset every single time because gradual decline is politically unacceptable. It happens slowly enough that people can assign blame. They can vote out leaders, they can protest, they can organize. But a sudden reset happens over a weekend. By the time people understand what's happened, it's already done. And it gets framed as emergency action to prevent something worse. That's the pattern. Financial crises don't create resets. Resets create solutions to financial crises. The crisis is the justification. The reset is the plan. So how would it actually work? Not theory, not speculation. A playbook based on historical precedent and current policy discussions. Step 1. The triggering event. Something breaks. It could be a sovereign debt default. Italy or Japan announces it can't make bond payments. It could be a banking crisis. A major institution fails and contagion spreads. It could be a geopolitical shock, a war that disrupts energy supplies, or a trade bloc that fractures. The specific trigger doesn't matter. What matters is that it creates enough fear and instability to justify emergency action. The trigger doesn't have to be catastrophic. It just has to be severe enough that when policymakers announce extraordinary measures, the public accepts them as necessary. In 1933, it was the Great Depression. In 1971, it was gold redemptions threatening the Treasury. In 1985, it was trade imbalances destroying manufacturing. Each time, the crisis was real. But the solution was planned in advance, waiting for the right moment. Step 2. Emergency meetings. Finance ministers and central bank governors don't wait for the crisis to peak. They act while markets are panicking. The G7 convenes, then the G20, the International Monetary Fund, gets involved. The Bank for International Settlements hosts technical discussions. These meetings happen in Basel, in Washington, in closed rooms where press isn't allowed and minutes aren't published until years later, if ever. The language in these meetings is always the same. Stabilization, preventing contagion, protecting the international monetary system. They're not talking about helping you. They're talking about preserving the structure that allows governments to borrow and spend without immediate consequences. And the solution they arrive at every time involves changing the value of money. In the modern era, that conversation would focus on special drawing rights. That's the IMF's synthetic reserve asset, created in 1969 as a supplement to existing reserve currencies. Right now, SDRs are valued based on a basket of 5 currencies: the US dollar, the euro, the Chinese yuan, the Japanese yen, the British pound. But that basket can be rated, it can be expanded, and it can be used as the foundation for a new monetary system. Leaked policy papers from the IMF have discussed exactly this scenario. In 2010, they published a staff position note exploring how a shift toward SDR-based reserves could reduce global imbalances and provide a more stable international monetary system. The paper openly acknowledged this would require reducing the dollar's dominance. It suggested this could be achieved through coordinated revaluation. That's not conspiracy. That's published policy analysis from the institution that would implement a global currency reset. Step 3. The announcement. It comes on a Friday evening after markets close or over a weekend. A joint statement from major central banks and treasury departments. The language is technical. It mentions unsustainable imbalances. It frames the action as necessary to prevent a deeper crisis. The key detail is buried in the middle. Effective Monday morning, the US dollar will be revalued against a basket of currencies and commodities by a specified percentage, 30%, 40%. The exact number depends on how much debt needs to be reduced and how much pain policymakers think the system can absorb. Other major currencies adjust simultaneously. The euro might devalue by 20%, the yen by 25%. Emerging market currencies might actually strengthen because they're not carrying the same debt burden. The entire global price structure shifts in a single moment. By the time markets open Monday morning, it's already done. Banks have updated their systems, exchange rates have been reset, and anyone holding cash, bonds, or dollar-denominated assets just lost 30 to 40% of their purchasing power. Step 4. Implementation and control. The immediate aftermath is chaos. Import prices spike because dollars buy less. Gas prices jump. Grocery bills surge. People panic. There are runs on banks. There's anger, protests, demands for accountability. But the government is ready. Emergency measures get implemented. Price controls on essential goods, restrictions on capital flows to prevent money from fleeing the country, expanded social programs to cushion the blow for the poorest citizens. It's all framed as protecting people from the crisis, not as managing the consequences of the reset. And here's the crucial part. Wages don't adjust immediately. Your salary stays the same in nominal dollar terms. You're still making $60,000 a year. But that $60,000 now buys, what, $40,000 bought last week? Your standard of living just dropped 30%, but your paycheck looks identical. Meanwhile, the government's debt, which is denominated in dollars, just became 30% cheaper to service. If the debt was $35 trillion before the reset, it's effectively $25 trillion in purchasing power terms after. The government just saved $10 trillion without passing a single budget cut. That's the mechanism. A hidden tax, a wealth transfer disguised as monetary policy. And it's not new. It's not innovative. It's the oldest trick in the book, executed with modern financial technology. This isn't just academic theory. Real policy discussions have centered on exactly these scenarios. In 2020, the World Economic Forum held sessions titled The Great Reset. The discussions included debt restructuring, new monetary frameworks, and what they called building back better. The language was optimistic, forward-thinking, but the substance was about resetting financial obligations and rebalancing global economic power. Central bankers are blunt in their internal discussions. Former Federal Reserve Chair Ben Bernanke once said, "The government is not going to print money and monetize the debt." But years later, that's exactly what happened during quantitative easing. The Fed bought trillions in treasury bonds, essentially creating money to finance government spending. They just called it something else. The same pattern applies to currency resets. They won't call it devaluation. They won't call it confiscation. They'll call it recalibration, rebalancing, modernizing the international monetary system. But the outcome is identical. Your money becomes worth less. Their debt becomes more manageable. And the pain gets distributed to people who have no voice in the decision. Now let's talk about who sees it coming. Not retail investors, not workers, not small savers. They find out when it's announced. But foreign central banks are already positioning. China has been buying gold at the fastest pace in decades. 1,600 tons purchased in just the last 2 years. That's not diversification. Russia sold off the majority of its U.S. Treasury holdings between 2018 and 2020. They shifted reserves into gold, yuan, and other currencies. When Western sanctions hit after the Ukraine invasion, Russia's financial system didn't collapse like policymakers expected. Why? Because they'd already insulated themselves from dollar dependence. Even traditionally Western-aligned countries are hedging. Germany repatriated 300 tons of gold from New York Federal Reserve vaults between 2013 and 2020. France did the same. The official explanation was logistical. Better to have gold stored domestically. But the real reason is trust. When you're not sure the monetary system will hold, you want physical assets under your control. These moves don't make headlines. They're announced in central bank reports that nobody reads. But the pattern is clear. Countries that understand how currency resets work are quietly protecting themselves. And if the central banks are protecting themselves, what does that tell you about their confidence in the current system? Here's what terrifies me about this moment in history. The average person has no idea this is even possible. They assume money is stable because it's been relatively stable their entire lives. They assume governments can't just change the value of currency because that would be unfair. They assume there would be debate, discussion, democratic process. But history proves otherwise. When the 1933 gold confiscation happened, most Americans found out from radio broadcasts after the order was signed. When Nixon closed the gold window, the announcement came on Sunday night television. Markets were closed. Banks were closed. By the time institutions reopened, the decision was irreversible. When the Plaza Accord devalued the dollar, the meeting happened in secret. The agreement was announced after it was finalized. Currency traders, businesses, foreign governments, they all woke up to a new reality. That's how monetary policy works. It's not democratic. It's not transparent. It's decided by technocrats who operate under the justification that markets would panic if they knew what was being discussed. And maybe that's true. Maybe transparency would cause the very crisis they're trying to prevent. But it also means you have no warning, no time to prepare, no ability to protect yourself. So what does this mean for you? Your savings, your retirement, your ability to preserve wealth across a potential reset. If the dollar loses 30 to 40% of its purchasing power overnight, every asset denominated in dollars loses the same amount. Your checking account, your money market fund, your treasury bonds, even your salary, effectively because prices adjust faster than wages. The only assets that survive a currency reset are the ones that aren't priced in the currency being reset. Real estate holds value because property doesn't change regardless of what currency it's priced in. Though property taxes rise and maintenance costs spike while your income lags, commodities, especially gold and silver, maintain purchasing power because they've been stores of value for thousands of years across every monetary system humanity has ever created. Stocks can survive, but only specific kinds. Companies that generate revenue internationally benefit from dollar devaluation because foreign earnings become worth more in dollar terms. Companies that produce essential goods can pass costs to consumers. But companies dependent on domestic consumption with thin margins and high debt loads get crushed. And then there are decentralized assets, cryptocurrencies, digital stores of value that exist. Outside traditional banking systems, the value proposition is precisely this scenario. If you can't trust governments not to devalue currency, you move into assets governments don't control. Whether that's wise depends on your risk tolerance and belief in the technology. But the reason Bitcoin was created in 2009, right after the financial crisis, was specifically as a response to monetary manipulation. This isn't financial advice. I can't tell you what to do with your money, but I can tell you what history shows. Every time a currency reset has occurred, people holding the devalued currency lost wealth. People holding hard assets preserved it. That's not opinion. That's historical record spanning centuries and dozens of countries. And here's the final piece that should make you uncomfortable. The people making these decisions, the central bankers, the treasury secretaries, the finance ministers, they're insulated from the consequences. They have access to information you don't. They have assets structured in ways you probably don't. And when the reset happens, their wealth is protected while yours evaporates. That's not a moral judgment. It's an observation about incentives. When you design the rules of the game, you make sure you win regardless of the outcome. The burden always falls on people who don't have representation in the room where decisions get made. Right now, all the conditions for a reset are aligning. Debt is mathematically unsustainable. Deficits are exploding. Foreign creditors are reducing dollar exposure. Central banks are building alternative payment infrastructure. The historical precedent is crystal clear, and the window to prepare is closing. You can ignore this. You can assume it won't happen in your lifetime. You can trust that this time is different. Or you can look at 1933, 1971, 1985, and recognize that when debt becomes too large, governments don't default. They devalue. They reset. They rewrite the rules. And they do it quietly. Over a weekend, with no warning, by the time you wake up Monday morning, the value of your money has already changed. Not because of market forces, not because of economic growth, but because a room full of people you've never met decided your purchasing power was negotiable. The silent currency reset isn't a prediction, it's a playbook. And all the evidence suggests we're watching the final chapters being written right now. The question isn't whether you believe it will happen. The question is whether you're ready if it does.